Market Recap. I'm Daniel.
And I'm Mira.
Today, you watch U.S. warships actually escort chemical tankers through a blockaded Middle Eastern choke point.
Which is just wild.
Completely. And it crashed the global price of oil. But, instead of panicking over all that geopolitical chaos, the stock market just relentlessly rallied.
Right. It totally ignored the noise to focus on this $200 billion artificial intelligence spending spree.
Exactly. I mean, we're looking at a day that defied almost every traditional rule of market gravity.
The resilience out there was just staggering. So just to quickly summarize the Tuesday, May 5th, 2026 market action, U.S. equities relentlessly shrugged off those early geopolitical fears.
Give us the numbers.
Well, S&P 500 futures hit an intraday high of 7,304.275.
Wow.
Yeah, before settling at 7,294.00. And NASDAQ futures surged to close at an impressive 28,198.50.
Which is a massive move.
It really is, and the ultimate relief valve was energy. Crude oil actually plunged roughly 4% on the day.
It is just a phenomenal setup to unpack for you guys today. But before we get into the mechanics of how this all happened, I do want to clearly state that this deep dive is strictly for market context and discussion.
Right. Definitely not personal investment advice or, an investment recommendation.
Exactly. We are simply here to help you understand the baseline you are operating against.
So let's jump right in. Session 1. What set the stage before the U.S. session?
You really cannot appreciate the relief rally without understanding the deep anxiety that was hanging over the market from the prior session on Monday, May 4th.
Yeah, heading into Tuesday morning, markets were sweating a pretty unprecedented energy spike.
Because Iran had blocked the Strait of Hormuz.
Right. We saw WTI crude surging past $106 a barrel, and Brent was over $114.
And for context, WTI is the U.S. domestic oil benchmark, while Brent crude prices the international waterborne market.
Both were just flashing bright red, signaling a potential global supply chain crisis.
I mean, the Strait of Hormuz is essentially the jugular vein of the global energy market.
Oh, absolutely. A massive percentage of the world's liquid petroleum passes through that narrow waterway.
So when it gets blocked, the market doesn't just price in the delayed shipments, it prices in soaring maritime insurance premiums and the immediate scarcity of physical barrels.
Because, as we know, energy shocks act as a lagged consumer tax, draining discretionary spending from the economy over time.
And that fear spilled directly into the pre-market overnight hours. At 12:30 a.m. Eastern Time on Tuesday, the Reserve Bank of Australia delivered a pretty severe wake-up call to the global markets.
They did. They raised their cash rate target by 25 basis points to 4.35%.
And RBA Governor Bullock wasn't hiding the reasoning at all. She explicitly cited the current oil shock and rising fuel costs as worsening the inflation growth trade-off.
When you look at the mechanics of why a central bank in Australia is reacting so aggressively to a blockade in the Middle East, it basically comes down to a confluence of factors.
Like currency dynamics.
Right. When the RBA looks at oil priced in U.S. dollars, they know that currency weakness mechanically imports inflation.
So if they don't hike while other major economies stay hawkish, the Australian dollar drops.
Exactly, making that $106 barrel of oil even more expensive for their local businesses to import.
But, here's where I really want to dissect the logic, because on the surface, this feels deeply counterintuitive.
How so?
Well, we talk often about how monetary policy cannot fix supply shocks. I mean, if oil prices are spiking because of a physical naval blockade, hiking interest rates in Australia doesn't clear a shipping lane.
No, it definitely doesn't.
You cannot print more oil, and you cannot unblock a strait with a 25 basis point hike. It feels a bit like hitting the brakes on your car just because the price of gas went up.
That's a great analogy.
Right. It doesn't make the gas cheaper. It just ensures you arrive at your destination much slower.
It's a perfect way to visualize it. But the central bank is looking past the immediate price of gas and focusing on the psychology of the passengers in that car.
Meaning inflation expectations.
Precisely. Central bank credibility anchors those inflation expectations. If we look back at historical precedents like the 1970s, central bankers learned a brutal lesson.
That if you accommodate a supply shock and let inflation run hot, the psychology of the economy shifts.
Yeah. Workers see high gas prices today, so they demand a 10% wage increase tomorrow. Businesses anticipate those wage increases and raise their prices in advance.
And suddenly, a temporary physical shortage transforms into a permanent, entrenched wage price spiral.
Right. So the RBA was essentially taking the hit to economic growth today to prevent a psychological inflation spiral tomorrow.
Which makes sense. Governor Bullock noted that many Australian companies haven't transferred these higher costs to consumers yet, but more are anticipating above-average price increases.
So they had to hike to defend their credibility and stop those businesses from passing the costs along.
Which created a really globally tense inflation environment heading into the U.S. morning. We had a blocked choke point and a major central bank actively hiking rates into a supply shock.
It really looked like the perfect storm for a market sell-off. The overarching fear was that the Federal Reserve would look at this exact same dynamic and be forced to stay higher for longer.
But as the opening bell rang, the script completely flipped. So let's take a quick break, and then we'll dive right into our next segment to see how that happened.
Sounds good.
Welcome back. Let's move to session 2. What moved markets during U.S. trading hours?
Well, the definitive answer is military intervention and a sprawling intraday reversal in the energy markets.
We saw the launch of what is being called Project Freedom.
Right. The U.S. military successfully escorted commercial ships safely through the Strait of Hormuz.
And we are talking about highly critical logistics vessels here, including a Maersk ship and the CS Anthem chemical tanker.
The mechanics of this are just fascinating. A military escort means U.S. Navy destroyers are physically positioning themselves alongside these commercial vessels.
And the moment those ships made it through safely, the geopolitical risk premium that was baked into the price of oil just completely evaporated.
The relief in the commodity markets was instantaneous. WTI crude broke down to settle at $102.27, which is a drop of 3.9%.
And Brent crude dropped 4% to settle at $109.87 a barrel, right around 2:30 p.m. Eastern Time.
The contrast in the timeline is what makes this so compelling. I mean, if we rewind just a few hours earlier, around 2 a.m. Eastern Time on Tuesday, Iranian leaders were issuing incredibly harsh threats.
Yeah, President Pezeshkian and Parliament Speaker Kolobaf explicitly refused to voluntarily open the strait, warning that any action disruptive to their security would face a severe response.
For an average observer watching the tape, that looked like an unpredictable disaster waiting to happen.
But the market didn't panic at all.
Because the market often views geopolitical brinkmanship as game theory leverage. Both sides were maximizing their rhetorical posture to establish a new dynamic.
So the equity market's essentially called the bluff.
Exactly. Once those U.S. military escorts proved successful and the ships actually moved without sparking a wider kinetic conflict, investors aggressively faded the risk and started buying stocks.
The absolute worst-case scenario of a totally frozen global supply chain was taken off the table.
Right. And just to be absolutely clear for you listening, we are looking at these military actions, the blockades, and these statements as pure, impartial, market-moving facts.
Yeah, we aren't endorsing any geopolitical side or action here. We are simply tracking the flow of risk.
And the risk definitely drained out of the oil market. But foreign affairs were only half the story today.
True. We also received a major slate of domestic macro data that painted a very complex picture of the U.S. economy.
We did. At 10 a.m. Eastern Time on Tuesday, the U.S. ISM Services PMI came in at a resilient 53.6.
And for anyone who doesn't track these surveys daily, the ISM is a diffusion index where 50 is the magic baseline. Anything above 50 means the services sector is expanding.
So 53.6 missed the forecast by a hair, but it still proves the core of the U.S. economy is growing.
Additionally, JOLTS, which tracks job openings, slightly beat estimates at 6.9 million.
Showing the labor market remains historically tight.
But here's the data point that normally would have sent the market into a tailspin. The ISM Prices Paid Index came in smoking hot at 70.7.
Wow. Yeah, this is the sub-index that tracks whether purchasing managers are paying more or less for their raw materials and inputs.
A 70.7 means inflation at the wholesale level is still burning incredibly hot. It is a leading indicator for consumer prices down the line.
So when you synthesize all that data, you get a very specific, challenging scenario. The U.S. labor market and services demand are holding up perfectly.
But that high prices paid component keeps the Federal Reserve in a tight, hawkish bind.
They absolutely cannot cut interest rates when services inflation is running at a 70.7.
Which normally would terrify equity investors. High inflation data means high interest rates, which usually means stocks go down.
But because oil prices collapsed on the back of those military escorts, equities rejoiced anyway. Investors looked past the hawkish data.
We know that fixed-rate debt cushions consumers, meaning many households locked in low mortgages years ago and are somewhat insulated from the Fed's stance.
Right. The market decided the economy was strong enough to handle the Fed. And the VIX, the market's 30-day implied volatility index, often called the fear gauge, remained incredibly subdued.
Yeah, just hovering right around 17.38 intraday.
It was a remarkable midday synthesis. The successful military relief in the Strait of Hormuz crashed oil prices, and that relief, combined with highly resilient domestic data, fueled a sustained rally.
So we'll take another short break here. When we come back, we'll dive into the tech sector, which is what really sent this market into the stratosphere.
Stay tuned.
Welcome back. Let's move into our final segment, Session 3, Corporate Events Recap and What to Watch Next.
To understand the magnitude of the tech rally today, we have to anchor it to the corporate events that actually happened before Tuesday's opening bell.
Right, the after-hours action from Monday.
Exactly. On Monday, May 4th, at roughly 4:05 p.m. Eastern Time, so right after U.S. trading hours closed, several key players reported earnings.
And AMD announced that customer engagement around its advanced MI450 chips and Helios products is rapidly strengthening.
We also had Supermicro Computer and Palantir reporting highly optimistic numbers.
I am looking at these earnings from Monday night, and they seem to be the missing link that gave the market permission to completely ignore the hawkish Fed data today.
It really validated the massive hardware spending boom. It proved that the demand isn't theoretical, it's real, and it set the stage for Tuesday's explosive tech headlines.
We're watching AI CapEx act as a self-reinforcing arms race. I mean, the numbers crossing the wire today were just staggering.
The scale of the capital commitments is almost hard to comprehend. We received reports today that Anthropic committed to spending roughly $200 billion with Google Cloud over 5 years.
That is massive. And meanwhile, OpenAI announced plans to spend $50 billion on computing in 2026 alone.
Let's break down what $50 billion in 1 year actually looks like, because this isn't traditional software cycle. You aren't just hiring engineers and writing code.
No, this is a heavy industry infrastructure cycle. Securing $50 billion in compute means acquiring vast tracts of physical real estate for data centers.
It means securing gigawatts of electricity, building industrial cooling systems, and buying hundreds of thousands of specialized GPUs.
And that physical reality explains the other major headline we saw on Tuesday afternoon. Reports surfaced that Apple is actively testing AI integrations with Google and Anthropic for iOS 27.
Which is a huge structural shift. Why would Apple, a company famous for its walled garden and building everything in-house, outsource something this critical?
It comes down to the CapEx barriers we just discussed. Apple's entire annual research and development budget is roughly $30 billion.
Right, so if OpenAI is spending $50 billion a year just on compute, even a giant like Apple prefers to partner on these generalized frontier models rather than trying to build the physical infrastructure from scratch immediately.
This creates an incredible psychological shift in the market. When you see Anthropic, OpenAI, and Apple committing hundreds of billions of dollars, it provides ironclad revenue visibility for the entire semiconductor and cloud supply chain.
You aren't guessing if these companies will make money next quarter. The contracts are already signed.
But beyond the corporate spending, there was also a major policy catalyst early Tuesday that cleared the runway for this rally.
Yes, at 7:30 a.m. Eastern Time on Tuesday, the Commerce Department announced that a broad coalition, including Google DeepMind, Microsoft, and xAI, agreed to let the federal government evaluate their frontier AI models before release.
On the surface, that might sound like a minor bureaucratic detail, but the market absolutely loved it.
Why? Because it removed a catastrophic tail risk. A collaborative regulatory approach removes the fear of draconian government intervention.
If these tech titans are working voluntarily with Washington on safety testing, it drastically lowers the chance of a sudden blanket ban or a sprawling regulatory crackdown that could halt the commercialization of generative AI.
It gave institutional investors the green light to keep buying.
Okay, I hear all of this, but I have to play devil's advocate for a moment.
Go for it.
I'm looking at the bond market, and the 10-year Treasury yield is still sitting relatively high at 4.416%.
True.
We know the foundational rule of finance, right? Discount rates act as gravity on valuations. That gravity hasn't magically disappeared just because tech giants are spending money.
No, it hasn't.
A 4.4% risk-free rate means the hurdle for future earnings is high. So is this rally ignoring the reality of the cost of capital?
It is a vital challenge to raise. I mean, in a normal environment, a 4.416% 10-year yield would severely compress the multiples of high-growth tech stocks.
Right.
But the market isn't treating these companies like speculative growth stocks right now. Investors are treating mega-cap tech as a defensive safe haven.
That is a fascinating pivot. Tech as a safe haven, almost like a utility company.
Exactly. Think of it as a fortress. Investors are looking at a world fraught with geopolitical chaos, blockaded shipping lanes, sticky services inflation, and uncertain Federal Reserve policy.
So where is the safest place to allocate capital?
You hide in companies that have hundreds of billions of dollars in committed, contracted revenue from AI infrastructure. You hide in balance sheets that generate immense free cash flow and aren't reliant on cheap borrowing.
They aren't buying tech just for the upside. They are buying it for certainty in a deeply uncertain world.
They're buying the fortress.
Which actually leads me to something we've been tracking all day. Well, folks, it looks like the only thing flowing faster than the newly escorted oil through the Strait of Hormuz is the cash leaving tech giants' wallets for AI data centers.
That is incredibly accurate.
With companies like Anthropic throwing around $200 billion like it's loose change, it's nice to know we aren't the only ones ignoring the central bank's warnings about sticky inflation. So whether you're navigating a blockaded shipping lane or just your own 401k, rest easy tonight. At least your portfolio didn't need a U.S. Navy destroyer just to finish the day in the green.
That really does sum up the mood on the trading floor today.
So what's next on the calendar?
To ensure you are fully prepared for the rest of the week, here are the crucial catalysts to watch over the next 24 to 72 hours.
Let's hear them.
Wednesday, May 6th at 8:30 a.m. Eastern Time, Treasury quarterly refunding details.
Okay.
Wednesday, May 6th at 10:30 a.m. Eastern Time, EIA Weekly Petroleum Status Report. Thursday, May 7th at 8:30 a.m. Eastern Time, BLS Productivity and Costs, the preliminary Q1 read.
Lots of data.
Yes. Friday, May 8th at 8:30 a.m. Eastern Time, the April employment situation. And Friday, May 8th at 10 a.m. Eastern Time, Census Monthly Wholesale Trade.
Perfect. So as we wrap up this deep dive, I want to leave you with a final thought to mull over.
What is it?
Today was the ultimate proof that the physical economy constrained, virtual economy decoupled dynamic is fully in charge.
It really is.
Think deeply about the contrast we just discussed. While the physical world is dealing with blockaded straits, massive supply chain bottlenecks, and the literal need for military destroyers just to move oil from point A to point B.
The virtual economy is printing hundreds of billions of dollars for AI data centers.
Exactly, completely detached from those physical limits.
Yeah.
But data centers still need copper, they still need land, and they still need gigawatts of power.
They absolutely do.
So how long can these two economies remain decoupled before the physical world snaps the virtual world back to reality? Can you really build infinite virtual intelligence if the physical supply chains are constantly under siege?
We'd love to hear your thoughts and predictions on how this physical versus virtual collision plays out, so please share your insights in the comments below.